On behalf of the NSE ISB Trading Lab, I welcome you all. If you had joined us in one of our webinars in December, which was titled Anomalies Across the Globe, today we have the authors of the paper titled Anomalies Across the Globe, and I would request Dr. Tirthankar Patnaik, who is the Chief Economist at National Stock Exchange, to introduce the panelists and give a brief introduction. Dr. Tirthankar, over to you.
Thank you, Anand, and welcome everyone. Distinguished speakers, Professor Heiko Jacobs, Dr. Sebastian Muller, Prasanna Tantri, and the entire research team at the NSE ISB Trading Lab. A warm welcome to all on today's webinar on anomalies in international markets. The NSE Trading Lab was set up in 2014 with the aim to pursue research and promote policy dialogues in the areas of security trading, investments, and financial markets. The lab has made significant progress in unexplored research avenues in capital markets, corporate finance, asset pricing, etc. Having produced over 25 high-quality research papers that have been published in a number of reputed international journals, such as the RFS, the Review of Finance, the Journal of Money, Credit, and Banking, and so forth. Additionally, there are over 30 working papers that are being undertaken by the research lab at the research team at the lab. The research findings of the trading lab are also integrated well in educational courses offered at the ISB and internship programs for students and researchers. Another highlight of NSE's engagement with ISB is the annual flagship summer research conference, which is attended by eminent scholars, practitioners, and regulators from around the world. Today's webinar is organized under the aegis of the NSE ISB Trading Lab speaker series and an extension of the panel discussion organized by the lab in December last year, as Anand just mentioned, which was titled, Putting Academic Research to Practice. Professor Heiko Jacobs and Professor Sebastian Muller will help us understand the dimensionality and predictability of stock returns based on one of their research papers. Let me just make a quick introduction of the two authors. Dr. Jacobs serves as Professor and Chairholder of Finance at the University of Duisberg, Essen. His research primarily focuses on empirical capital market research, behavioral finance, and experimental finance. Some of his research has been published in top-tier journals such as the Journal of Financial Economics, the Review of Financial Studies, the Review of Finance, the Journal of Banking and Finance, to name a few. He has previously served as assistant professor at the University of Mannheim after completing his PhD from the same university. Professor Sebastian Muller is a professor of finance at the TUM School of Management, campus Heilbronn. His research focuses on empirical capital market research, asset management, and behavioral finance, specifically in price discovery process in financial markets, investment behavior of institutional and individual investors, and the digitalization of the financial industry. Professor Muller has received several awards for his research, which has been published in, again, leading finance journals, such as the Journal of Financial Economics and the Review of Financial Studies. Previously, Professor Muller served as the Professor of Corporate Finance at the German Graduate School of Management and Law, Heilbronn, and Assistant Professor in Finance at the University of Mannheim, where he obtained his PhD in Finance. He was also a visiting scholar at the University of California, Berkeley. Their research paper explores the dimensionality of stock returns in 44 countries, including North America, Europe, Japan, Pacific, and emerging markets based on over 240 cross-sectional predictors. The study concludes that there is a large geographic heterogeneity in the significance of individual characteristics and in time trends, which leads to substantial out-of-sample diversification gains for global multidimensional hedge fund portfolios. On behalf of NSE, I once again welcome you all to the webinar, and I hope you find this deliberation useful and insightful. Professor Jacob and Muller, over to you, sir.
Thanks a lot for the nice introduction. Thanks for having us. So unfortunately, you can't see me due to technical problems, but at least you can hear me, and I'll do some background, talk about our research questions, talk about the related literature, talk about the empirical setup, and then I will hand over to Sebastian, and you will also be able to see him. So I'd like to mention that this is research in progress, so we're currently revising and updating the paper, and we welcome any feedback that you might have. Could you switch over to the next slide, Sebastian? Yeah, so this is kind of a paper or graph that motivates our analysis. It's from a famous paper by Harvey et al. And what they are showing, basically, among others, is that there has been a massive increase in return predictive signals that have been published in academic, primarily top academic studies. So what you see here in this graph is the number of return predictive factors and the number of papers proposing these return predictive factors over time. And you can see that especially in the last 20 years, especially in the period, let's say 1995 till 2010 roughly, there have been proposed hundreds of return predictive factor. So what do I mean with a return predictive factor? I mean a pattern in the cross-section of stock returns that cannot be easily explained with standard measures of risk. So basically what one does here, and what we'll also do in our paper, is you focus on one observable, quantifiable firm characteristic. You form a long-short portfolio, typically in the US market, and then you would regress the returns of this long-short portfolio on the standard risk-based model, let's say CAPM or Pharma-Frame's de facto model, and then you get an alpha. And of course, most researchers then refer to this alpha as an anomaly, but we will interchangeably also use the terms return predictive factor or investment factor or return premium, something like that in the rest of the paper. Yeah, and what you can see from the slide here is that the number of factors that have been proposed just seems to explode. Of course, the question is how many of these factors are really there and what explains those factors? Obviously, this is a key area of finance because you like to understand, does capital flow to the right stocks? Is capital managed efficiently? Are markets efficient? And to answer this question, it's important to understand how many firm characteristics really predict returns. And in your mind, just take a guess for yourself. So what do you think, how many return predictive factors are out there? Is it really a couple of hundreds, like the survey paper here seemingly says, or is it that it's just maybe a handful of predictors? So we just don't know, right? So there's so many factors out there that have been proposed, but we really know little about which of these anomalies or return predictive factors really survives once we control for all the other characteristics, and also what explains those return predictive factors in the first place. And this is where we would like to shed new light on with our study. So next slide, please. So basically, there's three broad explanation attempts for the average return predictor, as you very likely know. So traditionally, people have focused on either the risk versus mispricing explanation, as can be seen, for instance, in a 2013 Nobel Prize, which was jointly awarded to Pharma, who's like one of the fathers of market efficiency, and who basically believes that return premia, at least some return premia, are out there, but they are not really anomalies. They can be explained by standard measures of risk or unconventional measures of risk. So basically, it's not an anomaly, it's rational compensation for some form of systematic risk. On the other hand, the Nobel Prize was given to Schiller, who, as Thaler, whose quote you see here, is one of the fathers of behavioral finance, and they do believe in mispricing. But then there's this third explanation, which is very important for our study, and this is data mining. And the basic idea behind data mining is that those return predictive factors, in fact, are not really there. It's just a statistical artifact stemming from the fact that many researchers and practitioners search the same data set, then stumble across something which looks abnormal, publish a paper on that, but in fact, we should not expect to see these abnormal returns going forward, because in fact, there is no economics behind it. It's just a pure statistical artifact. Or alternatively, it's just a manifestation of another factor out of these couple of hundreds that already has been proposed. So we just don't adequately control for these other factors. And this data mining perspective has gained, go to next slide, that's fine. And this data mining perspective has gained a lot of attention in recent years, primarily because so many of those factors have been proposed. So this is one trend in the literature. And then the second trend in the literature is that nowadays, most researchers don't focus on single anomalies or return predictive factors anymore, as it was the case like in the last 20 years. So basically, when you look at academic papers now in the last 5 or 6 years, what people are trying to do is look at the big picture of anomalies, trying to understand when do they work, why do they work, or why do they don't work, and what is the underlying reasoning behind that. And one attempt or one paper, one influential paper that has looked at anomalies as a whole, but only in the US context, is this paper here, Greenhand and Zhang, an influential paper which basically studied 94 return predictive signals, so patterns in the cross-section of US stock returns simultaneously. And this is also something that we are going to do. So instead of computing the return on each and every single anomaly and then just looking in isolation at this anomaly, what they're basically doing is throw everything into one big cross-sectional regression each month, and then look how many of these 94 return predictive signal have incremental power relative to all the other 93 return predictive signals that are also out there. And what they find, and this is then basically where the title of our paper comes into play, multidimensionality, is that 23 return predictive factors of these 94 have t-statistics larger than 3, which is kind of a new hurdle proposed by the paper I showed you in the beginning. So a very high statistical hurdle. In other words, they're basically saying that returns historically in the US have been multidimensional. There's more than 20 characteristics that have incremental power, even once we control for the other characteristics by putting everything into cross-sectional regressions and then looking at the average coefficient for that. However, one should say that this is not true, and this is then where it starts to becoming interesting for practitioners. They find that this is not true either in recent times. Recent times basically means from 2003 forward, because basically they're not able to precisely determine what happened at this point in time, but they're saying likely arbitrage costs decreased due to a number of institutional changes, like for instance, increased liquidity or filing, or that the SEC filing requirements changed. Firms had to report their reports quicker, something like that, and likely also increased competition due to quantitative arbitrageurs. And so we have this time dimension in the sense that stock return predictability, dimensionality drastically was reduced in the US for the last 20 years, and also in particular for large cap stocks. I'm going to talk about what I mean with large caps and small cap stocks in the following, because we also differentiate in our paper between large caps and small caps. So what we are basically doing in this paper is kind of extending this influential green hand in Zhang study by looking at the international markets, and I'll also be more precise about that, and also by increasing the number of return predictive signals quite a bit. So we are looking at 240 variables in total. I'll also be more precise about that. So why is that interesting? You might say it's just an out-of-sample test, but we think there's a number of interesting implications also in particular for practitioners. So first of all, we might ask the question, is return dimensionality similar in other markets? Because basically all those return predictive signals have been proposed for the US stock market only. And when data mining really is a good explanation for the average anomaly in the US, you might expect that we don't see much dimensionality or multidimensionality in international markets where these anomalies typically, or at least originally, have not been explored. But to give a small preview, in fact, what we'll find is a similar or even higher degree of multidimensionality in international markets. Then the second question that may be of interest is, are these incremental return predictive signals, so the return predictive signals independent of other return predictive signals, are they the same across regions, or is there some heterogeneity? You will see that there is, in fact, a lot of heterogeneity, which then leads over to the third interesting research question. And this is the question, are there benefits from international diversification? Let's imagine that the average anomaly is driven by risk, by some systematic global risk factor. Then we might assume that kind of combining those different strategies across different regions would not offer much diversification potential, because we have this global risk factor which drives all of those anomalies or return predictive factors. However, we will see that there seemingly is a lot of diversification potential, which indicates that risk likely is not at least the major return predictive signal behind that. And then finally, which I think is also of interest to practitioners, is the question, are there benefits from anomaly aggregation? Because what we're doing in our baseline analysis is just looking at, or kind of counting number of anomalies that are independently significant. But when there is in fact a lot of diversification potential among them, and if there is in fact a lot of heterogeneity, a lot of return predictive signals that matter independently, then we might benefit from that by putting everything into one global score. And we will see that this turns out to be true. So next slide, please. So final motivation question before we come then to the data. So what are some other good reasons to study international stock markets in general? And I would like to make at least 3 points here. One is just the economic importance. So standard measure of economic importance is of course market cap. Nowadays, at the moment, market cap is quite large in the US, like more than 50%. But if you average it across basically our sample period, then the US market has a weight of maybe 40–45%. So more than half of world stock market capitalization on average belongs to non-US markets. So therefore, it's important to study them, especially when we use alternative measures of economic importance like GDP. So in fact, non-US stock markets account for, or non-US countries account for almost 3/4 of world GDP. So therefore, getting a better understanding to what extent these markets are driven by certain return predictors is certainly of high importance. And then it's also academically important because it seems what we have in academia, at least if you believe this paper by Caroli here, is something like what he dubs a home bias in academic research, which means that I think more than 80% of papers that are published in the leading finance journals focus on the US stock market to some extent in asset pricing or corporate finance. And there's a mismatch between the number of studies focusing on US markets and the economic importance of non-US markets, as illustrated in point 1. And as mentioned on a previous slide, there is a number of other academic reasons related to, for instance, market efficiency, market segmentation, and so on, to look at non-US markets. And finally, it may be of interest to practitioners because if we take the findings of this Green et al. Paper, but also of a number of other important papers on US return predictability on face value, then it's basically bad news for quantitative arbitrageurs, because it basically says that in the last 10 or 20 years, kind of outperforming the US stock market with quantitative factor investing is becoming really tricky because basically return predictability is hardly there anymore. So therefore, it's important to understand, well, maybe there is still some return predictability in international markets, or maybe we can benefit from diversification. So it's basically about the additional value of active management. Next slide, please. So now we come to our data. We're talking about our data. So basically, we're looking here at the sample period from 1989 till 2015. As I mentioned, we're currently revising the paper, but at least at first, currently it seems that our general findings are similar if we kind of update the sample period. So basically, we're looking at 5 broad regions. One is North America. Then we have European countries. Then we're looking at emerging markets, at the Pacific region, including, for instance, Australia and Hong Kong, and at Japan. So there's a number of academic studies, including ours, that treats Japan as a separate country simply because of the economic importance that Japan has. And in fact, even though it's not the focus of our study, the return predictive signals in Japan, or return predictability in Japan, appears to be somewhat special, for instance, in the sense that momentum doesn't seem to work there. So basically, we're looking at what you see on the graph is the number of firms across years. So you can see that it's quite a broad study, where in most recent years we have more than 25,000 firms. And this is primarily driven in the more recent years by the increase in the number of firms in emerging markets or in the Pacific region, whereas in Europe or in North America, the number is relatively stable or even becomes smaller over time. So we assemble a large data set which contains stock market data, daily stock market data from DataStream, accounting data from WorldScope, and analyst-based information from IBIS. And yeah, it takes quite a lot of time and effort to build this data set, but in the interest of time, let's just stick with this picture and look here at the next slide, in which we start talking about the importance of firm size. So as I mentioned, this Green Hand Zhang paper and also other papers illustrate the importance of firm size in return predictability. So here's an illustration of this effect or problem. Let's say we're looking at stocks that are trading at the NYSE, US American stocks trading at the NYSE, which typically are relatively large cap stocks. And we would then form 10 portfolios based on the market cap size breakpoints of those stocks. And then we would basically sort all stocks in our sample in those different size portfolios. So portfolio 1 illustrates all stocks that are, or the fraction of all stocks in the sample that are below the first decile in market cap of stocks trading at the NYSE. So you might say all stocks that are here in portfolio 1 are relatively small stocks. This is likely what we would refer to as small caps. Maybe also the stocks here in portfolio 2, which are stocks below the 20th percentile of NYSE trading stocks. And you can see that, especially also in emerging markets, but in fact in virtually all other markets of this world, the number of small cap stocks is extremely large. So they have a relatively, by construction, a relatively small economic impact, maybe account for just a couple of percent of the market capitalization, but account for 60, 70, 80% of all firms, depending on how exactly we're doing the cutoffs here. And when we're computing return predictability for those different size groups, as you will see in the following, we tend to get quite different results for small firms and for large firms. And from an industry perspective, in the sense that we are interested in where can we exploit the return predictability, of course, focusing on small caps may be a bit problematic because those tend to be stocks with low liquidity and where it's just difficult to buy or sell large quantities of stocks. On the other hand, from an academic perspective, there's good reasons to focus on both small caps and on large cap stocks, depending on what our goal is. So looking at all stocks or looking at equally weighted returns, which gives a larger weight to small cap stocks, may be interesting in the sense that we are interested in understanding how widespread the return predictor is, but also there's good reasons to believe that maybe return predictive signals or anomalies are in general strongest among small cap stocks. So therefore, looking at the whole cross-section of stocks or focusing on small caps may be interesting. On the other hand, when we're looking at an economic perspective, trying to understand whether inefficiency or return predictability is also there for the largest stocks, then of course, either excluding the smallest stocks or choosing some regression framework which focuses on large cap stocks may be the more preferred version of doing so. So next slide, please. So here is what we're basically trying to look at. We are computing a large number of return predictive signals for basically all regions and all countries. So how do we arrive at our 240 signals? First of all, we're looking at 4 meta-studies that each of them identifies a number of return predictive signals, like this Green et al. Study or like this Harvey et al. Study that you saw at the beginning. And then we look we combine all those return predictive signals from those studies. So we're not able to compute each and every of those anomalies proposed in these studies for a number of reasons. One, because we only focus on standard data that is easy to gather for international data, whereas some other anomalies proposed for the US stock market, for instance, are based on option prices or short interest or corporate governance data, so data that we don't have, so we don't look at those anomalies. And we also exclude, let's say, combined anomalies, like for instance, enhanced momentum strategies. So we have our standard momentum strategy, but then there's dozens of variations proposed in the literature as individual anomalies that interact past returns, so our momentum signal, with other firm characteristics, like let's say analyst coverage or size or turnover. We don't look at those strategies because essentially we would like to put everything into a single regression and then look at the incremental impact. And if you would include those dozens of similar anomalies, we would run into statistical problems because they're highly interrelated, and then just putting them into a single regression can create problems. So this is the type of anomalies that we don't look at. But on the other hand, we do an additional literature review and identify 65 additional predictors that are not even proposed in those meta studies on anomalies. So there you can see that, in fact, if you do kind of a careful literature review, you will arrive at hundreds, likely 500 or so anomalies that are somewhere proposed in the academic literature. What we are then doing is, for each and every firm characteristic, we form portfolios in each month and assign deciles to those stocks. Like for instance, in our standard momentum strategy, this would mean that firms with the highest past return are in decile 10 and are assigned a decile rank of 10, and firms in the lowest cumulative return are assigned a decile of 1. So we do this for each and every firm predictive or return predictive signal. So therefore, we kind of standardize return predictive signals. So each and every signal then has a value of 1, 2, and so on until 10. So we don't use the raw firm characteristics, for instance, to reduce the impact of outliers or to reduce the impact of data errors. So we kind of standardize the variables. You can see here in this graph that, in fact, the average correlation between return predictors is relatively low. So it's in fact relatively close to zero. And of course, there's a couple of them that are highly correlated with other characteristics. We look at the variance inflation factors to identify those and exclude the ones that are too highly correlated with other factors. So in the sense that they are likely to lead to statistical problems. But nevertheless, it seems that the average predictor, at least on paper, at least if we look at raw correlations, is relatively uncorrelated with all the other signals, which already points to the possibility that we might have diversification potential there. So next slide, please. So here's just a quick overview over some of the slides or some of the anomalies we're looking at. So I guess we don't, in the interest of time, we don't need to go into the details. It's just to illustrate that it's really a broad range of factors here. So it's basically market-based factors like momentum that are only based on past price or volume data. It's fundamental factors that are only based on balance sheet data, like let's say profitability. It's valuation-based predictors, like let's say some form of value, where we relate some market variable to some balance sheet variable. It's event-based strategies, like for instance, earnings surprises, and it's analyst-based strategies, or some combination of that. Like for instance, here the first anomaly, information uncertainty, is a composite anomaly that basically says that stocks with high information uncertainty proxied by a number of characteristics underperform stocks with low information uncertainty. So again, this is just to illustrate that it's really a broad range of different factors out there. Next slide, please. So our baseline research question then is, how many return predictive signal in each region provide independent information about future stock returns? So it's really about the dimensionality. And it's also about the question, even though it's a bit difficult to answer that, which variables do predict returns? And this is where this nothing else matters title part comes into play here. So what we're basically doing is, because sometimes the number of firms is too small relative to the number of firm characteristics to run cross-sectional regressions and then look at the average coefficient over time, what we're basically doing is we run a large pooled regression where we're trying to predict the return in the next month, so return at t+1, with all the firm characteristics observable at month t. So basically, we're trying to explain what the next return month is as a function of all the return predictors that we have and that are not highly correlated with other return predictive factors. And we put this all this into a kind of a single or relatively simple regression. And we run this regression in several ways to kind of account for the fact how important the different stocks are. So on the one hand, we simply run an OLS regression with all stocks. So basically small cap stocks will dominate. We also run this regression on the region level by beforehand excluding all non-micro cap stocks. And with non-micro cap, we mean stocks below the second NYSE decile, which is basically, I think, $600 million, roughly speaking, in 2015 at the end of our sample period. So to put this into perspective, and this has a massive impact on the firm universe we are looking at. So for instance, the median firm size in the all stock sample is about, I think, 110 million US dollars. Now, excluding those, what we call small cap stocks, leads to a median market cap of more than $1 billion US dollars. So it's likely a completely different sample, especially for practitioners. And alternatively, what we do is we do value-weighted last squares, which means that basically the weight is determined by the relative market capitalization. So it's an alternative way of giving more weight to the larger stocks. So this is basically our empirical setting. And now I would hand over to Sebastian, who's going to talk about our empirical findings.
Thank you, Heiko. Before I get started with an overview of the empirical results, first of all, thanks for the invitation and thanks for having us today. And yeah, here you can see our baseline assessment of return dimensionality. Heiko already explained that we look at the different regions in separate regressions and that we have 3 different samples with OLS all stocks, that's the dark blue bars, then OLS non-micro caps, that's well, the bar in the middle, and then value-weighted least squares, that's the light blue bars. And what you can see here on this figure are the number of statistically significant predictors, highly significant predictors that have an absolute t-statistic above 3 in these multidimensional regressions. And so when you look at this, you see that the number of statistically significant predictors is very high when we look at the complete stock universe. So it's for North America, it's 36 predictors that are statistically significant with a t-value above 3. Then for Europe, these numbers even higher with 49, Japan 33, then 47, and probably also very interesting for you in emerging markets, it's 41. So this tells us that, well, these predictors that have been established for US markets also to a large extent work internationally when we look at the entire cross-section of firms. However, this assessment of multidimensionality in the cross-section of returns is highly driven by how we treat microcaps. Once we exclude microcaps and only focus on non-microcap stocks, we see that the number of statistically significant predictors drops substantially, and basically in all regions, it's dropped substantially. So, and to some extent, this is also what we would expect. It's consistent with the idea that arbitrage or limits to arbitrage play an important role to explain anomalies. And in those stocks for which we have less limits to arbitrage, and we likely have more arbitrage activity, we also see less return predictability. And you see this drop also occurs when we use value-weighted least squares as an alternative regression methodology, which kind of confirms this picture that it's important how you treat those smaller stocks in your sample. So this is the baseline assessment, and then we kind of continue by looking at different parts of our sample or different sample periods. So we separate our sample period into two halves. First, the period before 2003, and then the period after 2003. And we do this with the idea in mind that Greenhand and Zhang in their study showed that this return dimensionality substantially dropped post-2003. So we are interested if we can see the same picture in international markets. And it turns out that this is not entirely the case. So here we focus only on the larger stocks just to get rid of these really microcaps. So we just look at regressions that only include non-microcap stocks and then value-weighted least squared regressions. And we see that when we combine the number of statistical predictors in these two regression types, that we have this kind of drop in North America, which is consistent with the findings of Greenhand and Zhang from 21 to only 12. But in other markets, it's not entirely the same. So in Japan, we also see the drop, but in Europe, for instance, the drop is less pronounced. And then in other markets, like in the Pacific region and in emerging markets, we even see an increase in the number of statistically significant predictors. So in emerging markets, there are not so many predictors that work in the pre-2003 period, only 6, but in the post-2003 period, we have 12. So this is again consistent with the idea that really arbitrage forces or the existence of arbitrage forces can explain anomalies. So in the United States, we might argue that markets became more efficient over time, so arbitrage was less costly or became less costly over time, and that explains why we see this drop, why we wouldn't assume so for emerging markets, for which we see, in fact, an increase in the return predictability. Yeah, so we see also heterogeneity in the evolvement of return predictability across the different markets. And then we are interested in this heterogeneity of the predictors. So the question here that Heiko already introduced is, do we see the same return predictors working everywhere, or are there cross-market differences. And to analyze this question, we calculate the correlations of the t-statistics of the regression predictors in large cap regressions. And this is what you can see here. So we are interested if one predictor that works in North America also works in these other markets. And the correlation tells us if this is the case. And when you look at these numbers, what you can see is that, yes, there seems to be, the correlations are positive. So this tells us that there is some kind of alignment in the predictability. So in general, we can say that predictors work in the same direction. So if momentum is positively related to future returns in, let's say, North America, then it is likely that momentum is also positively related to future returns in those other markets. On the other hand, this correlation coefficient is, it's not one, it's, so there's not really a perfect alignment. In this regional heterogeneity and the statistical significance of these stock return determinants is also consistent with what has been documented in a couple of prior studies that have focused on individual anomalies. So there's, for instance, this quite influential studies by Chu and co-authors who study momentum effect or momentum returns across markets and find that momentum is larger in individualistic markets, like in the US and Western European countries and so on. Now, our research suggests that this kind of isolated evidence for one anomaly can in fact be observed for many anomalies. So heterogeneity is a widespread phenomenon when we look at anomalies and does not only apply to some isolated anomalies. So this table here basically tells us the same story. What we do here is we look at those predictors that are statistically significant in one specific region. Let's start here with North America. And then we look at how large the return is that we can infer from the regression results and how large the average t-statistic is. So in North America, all predictors that have a t-stat about an absolute t-stat above 3 have an average annualized return of more than 8% per year. The average t-statistic is above 4. Now, and then in the next step, we look at how many of these predictors also work internationally in other markets. So not in North America, but in all the other regions that we study. And we find that, for instance, for North America, only a little bit more than 21% of these predictors are also highly statistically significant in the other regions. And you can see that the average return is also substantially smaller. So it's not 8% as in North America, but it drops to 2.5%. And the average t-statistic also drops significantly. So this tells us that it's not necessarily the case that when we look at a study, for instance, that finds a new predictor that seems to be working for the United States, that we can kind of automatically say it should also be working in international markets. So this has to be tested, and it's not guaranteed that indeed it works. And this is now, I focused on the North American market, but when you look at other markets, you see that the picture is kind of similar in those other markets. So predictors that work in one market do not necessarily work in other markets. And then you might be interested in these, when you look at these, or when we talk about the 240 anomalies that we study, you might be interested in the question, what are the kind of predictors that really seem to be working across the globe? So what are the, well, most consistent return predictors in large cap regressions? So here in this table, on this slide, we again focus on regressions that kind of exclude or remove the impact of tiny microcap stocks. So there are different kind of regression specifications that you can run. You can either run Farmer-McBeth regressions or pooled panel regressions. There are different, those different weighting approaches, and there are different sample periods that you can have in mind. And our idea was here to pool the results that we get from these different regressions, which are 40 in total, and then look at those anomalies that show up statistically significant in basically most of these 40 different, conceptually different regression types. And then we came up with a list of predictors, of the top 10 predictors that seem to be really consistently working in international markets. And you can see these predictors yourself here. So I don't have the time to touch up on every of these predictors. But what is interesting in my view is that many of these predictors are kind of high frequency predictors. And typically these high frequency predictors are not in the scope of many asset pricing papers. So when you think of the French asset pricing models like the latest 5-factor model or the Q-factor model or the CARD 4-factor model, then typically other factors seem to have much more influence in empirical capital market research than those factors that show up here. So this anomaly, for instance, just to talk about one of them, the return of the same calendar month, basically what this anomaly tells us is that returns tend to have a seasonality. So the anomaly is basically looking at the return of the same calendar month in the last 10 or 20 years. And what it's basically saying is that when a stock has high returns in, let's say, June of a specific year, or gained high returns in June over the last 20 years, then it's likely to have also high returns in June of this year. So very interesting anomaly. It seems to be working in many markets, in many specifications, but it's not in the focus of many asset pricing studies. And so the conclusion is interesting. Many top predictors here are not really in the focus of empirical capital market research. Now, this was a kind of in-sample assessment of return dimensionality, but from a practical point of view, one would also be interested if these anomalies can be somehow combined to an aggregate composite measure so that we can use them together. So because we have seen that even in the large cap regressions, it's not one anomaly alone that can explain stock returns, but we still have a couple of significant predictors. One would be interested to combine them. And this is what we do in what we call pseudo out-of-sample tests. So here we have, over our sample period, a rolling window regression approach in which we use the last 120 months, so the last 10 years, to run an in-sample regression. And this in-sample regression tells us how important certain predictors were in the past, over the last 10 years. The regression results can then be mapped into the current characteristic values of our stock in a period T to make a prediction for the stock return in the next month. And this is what we consider as our out-of-sample test. So basically, we use the historical regression results and combine them with the current characteristic values to make a prediction about the stock return. And then, of course, we can relate this prediction, which we call ERET for expected return in month T+1. We can relate this in our test to the realized return and see if our prediction works or not. And of course, this is now only one specific moment in our sample period, but we can move on to the next month and repeat this methodology so that we have really this rolling window approach. And then we can look at the realized returns, and this is really a simple methodology, is that we sort our stock universe into quintiles, with the highest quintile of stocks having the highest expected stock return, and the lowest quintile of stocks having the lowest expected stock return. And then we can take the difference and see how large the difference in return is. And this is what you see here on this slide, again, separately for all the regions that we study. And again, to make a distinction between those many tiny stocks that are economically not so important and the bigger stocks, we have the same idea here, that we first look at equally weighted returns for the entire universe, then equally weighted stock returns, but only for big stocks, including only the non-microcap stocks, and then running also value-weighted portfolio tests. So where the market capitalization determines the weight of a stock in the portfolio. Now, when you look at the long-short raw returns per month, which you can see here, is the first thing that may be surprising to you, I don't know, is that when we look at the entire stock market, the return difference is really very pronounced, very large. So we see, for instance, for North America, we see a return spread of almost 5% per month. So this is not a yearly number, this is a monthly number. And we see this in all markets. It's also inconsistent with data mining explanation and the idea that all these predictors are not really there. They have been kind of constructed in an artificial way for the North American markets, because we see the high predictability in all the other markets as well. But what one can also say is that this high predictability is largely explained by the microcaps. Once we exclude them, we see that the out-of-sample performance drops substantially. So in value-weighted returns, for instance, the return spread shrinks to 1.7% for North America. For emerging markets, it shrinks from roughly 3% to 1.5%. So again, the idea that predictability is there, but it's substantially less pronounced for the economically important stocks. Instead of looking only at the raw returns, one may also be interested in the effect of factor adjustment. So what would happen if we look at the alpha controlling for a certain asset pricing model, as opposed to just looking at the raw returns? And this is what you can see here on this slide. So here, instead of the raw return, you can see the card for factor alpha of the long-short strategy. And basically, you see the same picture. The numbers are slightly different, but the patterns are the same, and the impression and conclusion is also, for us at least, the same. So we see that factor adjustment has only minor impact. Again, when we look at the entire stock universe, we see a substantial outperformance of the long-short strategy. But once we focus only on the larger stocks, this outperformance drops substantially. And this is another way of looking at risk adjustment. What you can see here are annualized Sharpe ratios for these different strategies. Again, for equally weighted stocks, equally weighted big stocks, and value weighted all stocks. And the annualized Sharpe ratios are very high when you look at the entire stock market, but considerably lower when you only look at big stocks. So again, the similar message. Now, this is focused on regions in isolation. So what we have not investigated so far is diversification benefits that we may get when we combine our long-short strategies across different regions. And that is what we do in the next step. So first, we calculate the correlations of the hedge portfolio returns, so these long-short strategies for international markets. And this is what you can see here. So you can see here this correlation matrix. And you shouldn't be surprised that you see numbers also below the diagonal and above the diagonal. The reason is that the correlation numbers that you see below here, they are based on equally weighted long-short hedge portfolio returns without the non-microcaps, whereas the numbers above are based on value-weighted long-short returns. So that's just as a remark that you are not surprised. But basically, what the numbers tell you is that the correlations are not very pronounced. There's one exception. So the correlation in the hedge portfolio returns for North America and Europe is 0.59 and 0.5. So that's probably what one would argue is a higher correlation, but the other correlations are rather modest. So in fact, there are even some correlations that are negative. So for emerging markets and Japan, for instance, the correlation is minus 0.09. So here you have you seem to have particular substantial diversification benefits. And in fact, that's also interesting. Particularly emerging markets seem to operate in a different mode, and here you have particularly high diversification benefits. And then what does this mean in practice when we construct a global hedge portfolio? So what we can do is we can combine an equally weighted way the hedge portfolio strategies for the different markets and have this global hedge portfolio strategy and analyze the risk and or the risk return profile of this strategy. And this is what you can see here on this slide. So in panel B, you can see the performance of the globally diversified hedge portfolio. Again, when we look at the entire stock market, that's equally weighted all. We only look at equally weighted big and at value weighted all stocks. And so the return numbers should not be surprising. That's simply the average of the regions. But what we can see is a substantial drop in the volatility of our strategies. So this is shown here in panel C. The risk of the globally diversified hedge portfolio drops substantially compared to the average across all regions. So it drops, the volatility drops to about 40% compared to the isolated volatility. And that's the benefit that you get from diversification when you run this global strategy as opposed to the isolated regional strategies. And as a result, also the Sharpe ratios that we have talked about that were in the range of 1.2 to 1.7 for the big stocks and the value-weighted stocks. These Sharpe ratios, as you can see here, they also increase substantially. So the Sharpe ratio is now for this combined strategy, even when we focus on bigger stocks, close to 3. So the message is that international diversification benefits are substantial because these strategies are not highly correlated across markets. And that's what we studied. So let me come to the conclusion. So what are the main findings of our study so far? And I said that we are currently in the process of revising the paper and also looking a bit more in detail about potential explanations with regards to limits of arbitrage. So far our conclusion is that all markets are highly dimensional and that microcaps have an important impact on our results and also on how we interpret or how we assess the degree of return dimensionality in markets. Or when we look at all stocks, we would say that return dimensionality is much more pronounced than if we only look at the economically important larger stocks. Then we find a very interesting cross-market heterogeneity in the significance of individual predictors. And our findings are most consistent with the idea that mispricing explains anomalies and that mispricing disappears once well, the favorable conditions that allow mispricing to exist disappear. So once arbitrage forces can work, mispricing becomes less pronounced in international markets. So the fact that we find that our predictors that have been introduced for the United States also seem to be working for international markets suggests that data mining appears to be less important than what has previously been thought, and that stock markets appear to be less efficient and more segmented than we previously thought. And that's it. And now I think it's time for questions from your side. And thank you very much for your attendance.
Thank you, professors, for the wonderful presentation. Once again, I would request everyone to put in their questions in the chat box. In the meanwhile, I'll proceed with the first question that we have. So someone wants to know that, professors, you have done your analysis across multiple geographies. You have segmented them into 5 geographies, one of which is emerging markets. So which are the, how many countries have you considered in the emerging markets, and do you have any results specific to India, which can be a takeaway? Have you looked at that level of granularity?
So unfortunately, in this study, we have not specifically looked at the Indian stock market in isolation. What we have in emerging markets is in total about 20 or 22 markets. So I can't recall the exact number, but it is in that range. And what you can see and what you can take from this figure here is that emerging markets became substantially.
There's one question which I think pertains more to this question is rolling window approach. Has it been used for future work, that is for the prediction?
Sorry, I had some problems with the internet connection. It's a bit slower, so I turned off my video. Can you repeat the question, please?
Sure. So the question, I think, was the rolling window approach which you have used, has it been used for future work, which is the future work of prediction of anomalies?
For future work. So what we really had in mind when we constructed this rolling window approach is that we wanted to have a fair assessment. When we thought about combining anomalies in a way how a real-life arbitrageur would likely do it. So when we are here in period T, say that's July 2000, we don't know what happens in the next 20 years. So we are uncertain about which characteristic matter here. And we wanted to reflect this in our procedure. So we only looked at the past data to really infer which characteristics worked in the past. And in this way, it is an implementable, or it would have been an implementable strategy from the perspective of an institutional investment manager. And so we wanted to have this fair assessment. There's no look-ahead bias in these regressions, and therefore we proceeded in this way.
I'd like to also mention this is not our own idea. So this Greenhand Zhang paper also uses this approach. There's a number of other papers out there who use this or similar approaches. And they also do it somewhat differently. For instance, the problem or one challenge that we might have with our analysis is that there's still some look-ahead bias in the sense that we're also including return predictors that may not have been known in real time because they were not published. But there are other papers that only look at published anomalies and do a rolling window approach, and they find very similar findings. So basically, I would say this is just a robust and intuitive way of trying to look at the aggregate impact of anomalies.
Thank you, Professor. We don't have a lot of time left, so we are going to take at max 1 or 2 questions very quickly. The next question is, do you see predictors losing their ability to predict over time? And it's followed by another question. Are these time trends contemporaneous across markets for predictors that are relevant across markets?
It's a bit difficult to say, I would say, because we can only say something about average predictors. And it appears that there's a lot of heterogeneity even across the ones that are most significant. So as you can see here in this graph, and also in some other work we have done, typically you find that the drop is really strongest for the US, and this may be related to general time effects. It may also be related to publication effects. Internationally, there is some drop, but typically only then when really arbitrage trading appears to be profitable. So basically what this paper and other work shows is that the drop is there when we're really looking at predictors that were highly significant in the past. So likely they draw a lot of arbitrage capital because this is where money seemingly could be made. And it's there when we're looking at large cap stocks, so where likely long short trading strategies can be more easily implemented. So I would say in the US, the drop is extremely strong. This is what many papers find. Internationally, it's there to a lesser degree. But again, we can only say so for the average important predictor, not necessarily for each of them. And I guess this is also reflected here in the graph. And then it depends on the regions, right? So as Sebastian has said, it appears that in emerging markets and some other parts of the world, in fact, the number even increases over time.
Right, thank you. We'll be taking the last question. So do the predictors analyzed in the model include shocks, or can big shocks, for instance, monetary policy shocks from the Fed, be incorporated in the model?
So
maybe
I
can answer to answer to this. So this is a kind of macroeconomic policy factor, and we haven't analyzed these macroeconomic factors. So we have really focused on individual stock characteristics, so characteristics that differ for each and every stock. However, it would be an interest, but we haven't done this, but could be an interesting question if these predictors work in a different way across different macroeconomic conditions. So this could be interesting, but we have not investigated this.
Yeah, I would say it's an interesting suggestion, definitely, because if you look at some anomalies, for instance, momentum is predicted to work in different times than value. And you might be able to kind of correlate this with the macroeconomic situation, for instance. And then, for instance, you might give a different weight to different predictors in this rolling sample regression at different points in time. And maybe the strategy then becomes even more convincing, or other return predictors appear to matter in different times. But indeed, we haven't looked at this, but yeah, maybe we will do so in future work.
Right. Thank you so much, professors. And with this, we conclude today's webinar. First and foremost, I would like to extend my gratitude to Professor Heiko Jacobs and Professor Sebastian Muller for taking out time and making us go through their incredible work. It was really enlightening. I would also like to thank the National Stock Exchange for sponsoring the NSE ISB Trading Lab, who was able to bring this webinar to you. I would like to thank all the participants. I would like to thank Professor Prasanna Tantri, the Executive Director of Center for Analytical Finance at CAF. I would like to thank everyone at ISB for making this possible. Thank you everyone for joining in, and we hope to see you soon again with another webinar. Thank you so much.
Thanks a lot. Bye-bye.
Thank you very much. Bye-bye.